Hello friends, most of us would be very familiar about these brands Pepsi, Aquafina, Mountain Dew, Gatorade, Tropicana, Sting, etc. And most of us would be using this in our daily life. These brands are marketed in India from Varun Beverages Limited through PepsiCo. Varun Beverages Limited has been associated with PepsiCo since the 1990s and is a key player in the beverage industry and one of the largest franchisee of PepsiCo in the world. The company produces and distributes a wide range of carbonated soft drinks, non-carbonated drinks, and packaged water sold under trademarks owned by PepsiCo. PepsiCo brands produced and sold by the company include Pepsi, 7 Up, Mirinda, Mountain Dew, Tropicana juices, and many more. Varun Beverages is a key player in the industry and is the largest franchisee of PepsiCo in the world outside USA. They do manufacture for them and they also distribute their products across India. The company produces and distributes a wide range of carbonated soft drink as well as large selection of non-carbonated beverages including packaged drinking water sold under the trademark of PepsiCo. Some of the brands from the beverages are Pepsi, Mountain Dew, Sting, 7 Up, Mirinda, Slice, Tropicana, Aquafina, Gatorade, Lipton Tea, Cream Bell, etc. The food it is Lay's, Doritos, Cheetos, Kurkure, etc. Varun Beverages is a part of the RJ Group established in the year 1995. The company is named after Mr. Ravi Jaipuria and Mr. Varun Jaipuria, who are the promoters of the larger RJ Corporation. Apart from PepsiCo, they are having franchisee model of popular QSR brands like KFC, Costa Coffee, Pizza Hut, Food Street, etc. from the food category, Cream Bell from ice cream category, TWGT from the tea category. These are the brands which are licensed to Varun Beverages Limited. The brands like Pepsi, Pepsi Black, Mountain Dew, Mirinda, and 7 Up are from the carbonated soft drinks category, Sting from energy drink, Eveves and Dukes from club soda, Nimbus from carbonated juice category, along with Tropicana, Slice, and Lipton Tea from the fruit punch segment, Gatorade from sports drink segment, Aquafina, Aquavest from packaged water category. Apart from this, they also have dairy-based beverages like mango shake, cold coffee, Belgian choco, kesar badam, and elaichi. Varun Beverages has a very good relationship with PepsiCo. PepsiCo does demand creation, while Varun Beverages provides demand delivery. Basically, the trademark of PepsiCo shares product formula to VBL, and VBL does production, sales, and distribution, as well as customer and retailer management. PepsiCo does formulation through concentrate, while VBL does sales and distribution along with logistics management. PepsiCo does product and packaging and also does research and development, while VBL does in-outlet management and also provides VZ coolers to the retailers. PepsiCo does consumer pull management through ATL. ATL stands for above the line, meaning that the advertisement is going to be deployed around a wider target audience, example television, radio, billboards, etc. Varun Beverages, on the other hand, does consumer push management through BTL strategy. BTL or below the line suggests that the advertisement is going to target a specific group of potential consumers through newspaper ads, print brochures, direct mail campaigns, and catalogs, etc. In India, 90% of the sales which PepsiCo does is done by Varun Beverages Limited. So in India, they are the market leader in this segment. Some of the key features of the company are other income which is not affecting the ratios of the company. Promoters have not pledged a significant portion of their holding. Companies converting accounting profit to its cash. Depreciation accounting is leading to increase in profits. ROCE, that is the return on capital employed of the company, has increased over the last 3 years. Company does not have significant contingent liabilities. Retail has been selling the stock, which is usually a good time to buy. The share price has increased over the last 10 years due to its phenomenal earnings. Net profit margin is responsible for return on equity, which is increased over the last 10 years. Working capital of the company seems to be under control. Company should not have any issues servicing its debt. Most importantly, the promoter has not sold any shares in the last 90 days. So all these parameters looks very good for the company. The company has invested on infrastructure to provide raw materials, manufacture the end product, and distributes pan-India through retail outlets. The company has solid distribution network which covers urban, semi-urban and rural markets. It also provides products, keeping an eye on customers' requirements and deliver them at ease through proper logistics operations. They execute products addressing demands of a wide range of consumers with good share of profits. The company has own facilities for production of preforms, crowns, boxes, plastic crates for certain facilities to ensure operational efficiencies and high quality standards, thereby increase market expansion and reduce operational costs. The company has very good cash reserves for funding on new products, research and development, for generating return on equity expansion and future growth. In 2023, 70.6% volumes came from selling carbonated soft drinks like Mirinda, Pepsi, 7-Up, Nimbus, etc. 22.7% volumes came from selling packaged drinking water, and rest 6.7% volume came from selling non-carbonated beverages like Tropicana, Slice, Lipton tea, etc. Sales volume have grown by 28% CAGR from FY 2018 to FY 2023, with 84% of volume coming from India and rest internationally. The company has 37 state-of-the-art manufacturing facilities in India and 6 at international level. It has a robust supply chain with 3 million plus retail outlets, 110 plus owned depots, 2,500 plus owned vehicles, 2,400 plus primary distributors, and currently installed more than 7,25,000 Visi coolers at outlets. This data is a geographical representation of manufacturing plants in India and at the rest of the world. If we look at the regulatory risk, the beverage industry remains responsive to changes in government regulations regarding the content of soft drinks and to increasing environmental concerns in India about groundwater depletion and discharge of liquid waste by bottling plants. Further, evolving concerns related to the disposal of plastic may impact the beverage industry. On capital expenditure, the company has invested rupees 6,300 million primarily for business expansions in India and rupees 2,500 million for expansion in Morocco and Zimbabwe. Additionally, rupees 3,700 million for purchasing land for future capacity expansions for the year 2024 to 2025. As of now, the company has a capital work in progress of approximately rupees 6,066 million for further greenfield expansion in Rajasthan and Madhya Pradesh and for existing plants in India. The total net capex estimated for FY 2026 is about rupees 15,500 million. This shows a significant and positive impact on production, expansion, and increase in growth in terms of revenue and profitability of the company. If you look at the company's revenue, it has increased from 51,053 million in 2018 to 1,33,749 million in 9 months of 2023. On profit after tax, it has increased from 2,999 million in 2018 to 19,581 million in 9 months of 2023. On EBITDA, it has increased from 10,066 million in 2018 to 31,912 million in 9 months of 2023. If you look at the net worth, it has increased from 20,063 million in 2018 to 66,226 million in H1 2023. So all these data and parameters augurs well for the company. Technically, if we look at the chart, it is trading in a range with upward movement. If it crosses above 1020, we could expect further increase in the share price for short term. However, if it corrects from here, Then there is a strong support at 890 levels. The company has listed in stock exchange in the year 2015 with a price band of 66 rupees. Presently, it is trading at the levels of 1013, generating all-time returns of 1445% to its shareholders. Its 5 years returns is at 745%, while its 1 year returns is at 87%, which is staggering. This clearly indicates that if we hold on to the stock with good fundamentals for a longer time, it will surely give good rewards to the investors. Varun Beverages Limited is a large cap company having a market cap of 1,31,089 crores. Its stock PE is at 65.6, while industry PE is at 39.4. However, since it is overly valued, we can look at some corrections before thinking about accumulating this stock. Its return on capital employed is at 27.4%, while return on equity is at 33.5%, which is very good. Company is having a debt to equity of 0.57, while its face value is at 5 rupees. So all fundamentals looks very solid for the company. If you look at the shareholding pattern of the company, promoters holding 63.09 percentage, while foreign institutional investors having 27.55 percentage, domestic institutional investors having 3.36 percentage, while public is holding 6.01 percentage. Good to see that the infusion of funds from the foreign institutional investors, as it has increased from 20.46 percentage in December 20 to 27.55 percentage in September 2023. Varun Beverages Limited accounts for 90% of India's revenue, so PepsiCo is completely dependent on VBL. PepsiCo has become national bottling partner for VBL because of its diversified products produced and marketed by VBL, starting from carbonated drinks to non-carbonated drinks and packaged drinking water. Its distribution and logistics were also easier due to single brand operation through VBL. So it is a clear winner in FMCG space. If you feel that this video has given any value add, we request you to kindly do like, share it with your friends, and do subscribe for more such interesting videos. Jai Hind.